Wait a second. Before you invest another dollar in silver, you need to understand this. You're not investing in a conservative precious metal. You're entering the most manipulated, volatile, and dangerous speculation in modern financial markets. This isn't a guess. You need to know that this is a result of market mechanics that have ruined speculators for over a century. If you've observed precious metal markets, you know that silver doesn't behave like gold. If you understand the difference between monetary assets and industrial commodities, you naturally know why silver speculation has bankrupted more investors than any other safe haven asset in history. But wait a minute, I have to say this. If you've studied market manipulation, you know that silver is the preferred playground of the world's most sophisticated financial predators. This isn't economics. This is economic engineering, and the silver market is designed to transfer wealth from small speculators to large institutions with mathematical precision. If you ask me what forces make silver speculation so attractive, I would tell you it's increased industrial demand, supply constraints, and the psychology of monetary metals, the same forces that make it systematically destructive for individual investors. First, there are some things you absolutely need to understand about silver markets. This is not an investment in precious metals. This is leveraged industrial commodity speculation disguised as monetary protection. When supply and demand imbalances occur in industrial commodities, price movements become exponentially more violent. When monetary psychology is added to this commodity, the volatility becomes a fortune-ruining problem for unprepared investors. If you've followed silver price movements over the last few decades, you've probably seen 70 to 80% drops become routine. These aren't market corrections. These are systematic attempts by speculators to reduce their capital and wealth. Silver is simultaneously the most volatile major commodity and the most psychologically attractive to monetary collapse theorists. This combination creates the perfect storm for speculation that appears as a prudent investment. Let me give you the exact mathematical figures because the numbers are both revealing and frightening. Silver's average annual volatility exceeds 35%, almost twice that of crude oil, 3 times that of gold. Yet silver marketing presents it as a kind of monetary insurance similar to the stability of gold. Between 1979 and 1980, silver rose from $6 to $50 per ounce, a gain of 733% that created legendary wealth stories. Can you believe it? Then what happened? It plummeted to $10 within months, wiping out 80% of the speculators' wealth. This pattern has been repeating itself consistently for over 40 years. The Hunt brothers' silver corner in 1979 to 80 was not an anomaly. It was a perfect example of how silver markets operate. Large leverage, industrial demand, and monetary psychology combine to lead to systemic wealth destruction for retail participants. Looking at history will show us how silver speculation unfolds in predictable cycles of euphoria and ruin. The mechanisms change, but the outcome remains constant for small speculators. Systemic wealth destruction. The Hunt brothers' collapse 1979 to 1980. Nelson Bunker Hunt and William Herbert Hunt, among America's wealthiest individuals, attempted to seize control of the global silver market. By accumulating 100 million ounces of silver and silver futures contracts, they drove prices from $6 to $50 per ounce. But what most silver speculators don't understand about the Hunt brothers' story is this: they weren't amateur investors. They had billions of dollars in sophisticated capital, connections to politicians, and of course industrial expertise. And yet they were completely destroyed by the mechanics of the silver market. So how did this happen? When collateral requirements increased and silver prices crashed and plummeted, this collapse cost the Hunt brothers over $1 billion. Let's say that's roughly equivalent to $4 billion today. If even billionaire oil tycoons with unlimited resources and market expertise can't successfully manipulate silver markets, what chance do individual speculators have? The mechanism was the same with every silver speculation cycle. Industrial demand initially creates price pressure. Monetary psychology attracts speculative capital. Leverage amplifies price movements. Then market mechanics violently reverse, destroying leveraged positions. The 2011 silver frenzy. Following the 2008 financial crisis, silver experienced another speculative bubble. Prices surged from $9 in 2008 to $48 in 2011, a 433% increase, creating a new generation of silver advocates. The marketing was the same with every silver bubble. Industrial demand is increasing. Central banks are devaluing currencies. Silver is undervalued compared to gold. This time it's different because of solar panels and electric vehicles. None of it mattered. Silver plummeted from $48 to $14 in subsequent years, wiping out 70% of speculators' wealth. Those who bought silver as monetary insurance saw their insurance policies lose two-thirds of their value, while the stock market tripled. The 2020 to 2021 Reddit rally. Social media speculation drove silver from $12 to $30 in months, creating another wave of destruction for retail investors who believed in internet marketing rather than market mechanics. The pattern never changes. Industrial narrative, monetary psychology, leverage and wealth destruction all converge. If you understand this cycle, silver speculation becomes overtly dangerous rather than mysteriously attractive. Let me explain the precise mechanism that makes silver markets so dangerous for individual speculators. Because if you understand the engineering, the wealth destruction becomes predictable. Silver is a schizophrenic asset, part industrial commodity, part monetary metal, part speculation vehicle. This identity crisis creates systematic manipulation opportunities that don't exist in purely monetary assets like gold or purely industrial commodities like copper. The silver market is a fraction of the size of gold markets, approximately $25 billion versus $12 trillion for gold. This size difference means relatively small amounts of capital can create massive price movements that attract speculative interest and media attention. But here's where the trap closes. The same small market size that allows dramatic price increases also enables equally dramatic price collapses. When leveraged speculators need to exit positions, there's insufficient liquidity to absorb selling pressure without devastating price declines. Industrial silver demand creates the illusion of fundamental support for prices. Solar panels, electronics, medical applications all require silver and are growing markets. This industrial narrative convinces investors they're making logical supply-demand investments rather than speculative bets. But industrial users are price sensitive and can substitute alternatives when silver becomes expensive. When speculation drives silver prices above industrial utility, demand destruction begins immediately. The fundamental support disappears precisely when speculators need it most. Financial institutions understand these mechanics and position accordingly. They provide leverage to retail speculators through ETFs, futures, and mining stocks, then systematically extract wealth when speculation reaches unsustainable levels. The silver market operates like a sophisticated wealth transfer machine. Industrial narratives attract speculative capital, leverage amplifies positions, market makers provide liquidity on the way up, then margin calls and liquidity withdrawal destroy leveraged positions on the way down. Silver speculators consistently fall for the industrial demand narrative because it sounds logical and scientific. Growing solar installations, expanding electronics manufacturing, increasing medical applications all require silver and are expanding rapidly. This narrative creates the illusion that silver speculation is actually intelligent commodity investing based on supply-demand fundamentals, but this thinking contains fatal flaws that destroy speculator wealth systematically. Industrial silver demand is price elastic. When speculation drives silver prices above $25.30 per ounce, industrial users begin substituting alternatives, recycling more aggressively, and reducing silver content in applications. The industrial demand that justified speculation disappears when speculators need it most. Compare this to gold, where monetary and jewelry demand is relatively price inelastic. Gold buyers purchase for status, wealth preservation, and monetary insurance functions that become more valuable as prices rise. Silver's industrial buyers purchase for functionality that becomes less valuable as prices rise. Solar panel manufacturers can use alternative materials when silver becomes expensive. Electronics companies can redesign circuits to use less silver. Medical device makers can substitute other antimicrobial materials. The industrial demand supporting silver prices evaporates under speculative pressure, but gold buyers cannot substitute alternatives for wealth preservation or monetary insurance. Central banks cannot buy copper instead of gold for reserves. Wealthy individuals cannot substitute aluminum for gold jewelry. Gold's monetary demand increases with price, while silver's industrial demand decreases. This fundamental difference means silver speculation fights against its own success while gold ownership benefits from price appreciation. Silver speculators are betting on industrial demand that disappears when they win their bet. Silver speculation typically involves leverage. either directly through futures contracts or indirectly through mining stocks and leveraged ETFs. This leverage creates the boom-bust cycles that systematically destroy speculator wealth. When silver prices begin rising, leveraged positions generate impressive returns that attract more speculative capital. A 20% move in silver prices can generate 100 to 200% returns in leveraged positions, creating the illusion of easy profits and brilliant analysis. But leverage works symmetrically. The same 20% price decline that wipes out leveraged positions happens more frequently and suddenly in silver than in other assets because of the market's small size and manipulation susceptibility. Silver mining stocks provide indirect leverage to silver prices, but with additional operational risks. Mining companies face production costs, environmental regulations, political risks, and execution challenges that amplify volatility beyond silver prices themselves. During silver price declines, mining stocks typically fall 2–3 times more than silver prices. A 50% decline in silver prices often translates to 75 to 90% declines in mining stock prices. Speculators seeking silver exposure through mining stocks face compound wealth destruction. Leveraged silver ETFs promise to deliver multiples of silver price movements, but systematically decay wealth through daily rebalancing in volatile markets. These instruments are designed for short-term trading, not long-term speculation, but are marketed to investors seeking silver exposure. The leverage trap works with mathematical precision. Initial gains attract more capital. Increased leverage amplifies positions. Volatility destroys leveraged capital. Survivors reduce positions. Reduced speculation enables more volatility. Remaining leveraged positions get destroyed. The cycle repeats every few years with new groups of speculators. Silver speculators often justify their positions by claiming central banks will eventually buy silver as monetary reserves, driving prices dramatically higher. This narrative ignores fundamental monetary realities that make silver unsuitable for central bank reserves. Central banks hold approximately 35,000 tons of gold worth $2.4 trillion as monetary reserves. They hold essentially zero silver for monetary purposes. This isn't historical accident or temporary oversight. It's rational monetary policy based on silver's unsuitable characteristics. Gold maintains consistent purchasing power over decades and centuries, making it suitable for long-term reserve storage. Silver experiences 70 to 80% drawdowns repeatedly, making it unsuitable for reserves that must maintain stable value. Gold markets are deep and liquid enough to accommodate central bank transactions without massive price disruption. Silver markets are too small and volatile for central bank participation without destabilizing price discovery. Gold has no significant industrial uses that compete with monetary demand, ensuring consistent availability for monetary purposes. Silver's industrial consumption means monetary demand competes with industrial users, creating supply constraints and price volatility. Central banks require predictable, stable monetary reserves that maintain purchasing power over long time horizons. Silver's industrial commodity characteristics make it fundamentally unsuitable for this purpose, regardless of monetary collapse theories. The central bank silver buying narrative is speculation fantasy that ignores practical monetary policy requirements. Central banks will continue holding gold, not silver, because monetary logic trumps speculation narratives. Here's the mathematical reality of silver speculation in current markets. If you put $50,000 into silver today expecting monetary collapse protection, you're not buying insurance. You're making a leveraged commodity bet with 70 to 80% downside risk and uncertain upside timing. Silver's price-to-production ratio is approximately 8 meles 10 years at current prices compared to 25+ years for gold. This means silver faces much more immediate supply pressure from increased mining when prices rise, limiting sustained price appreciation. Silver's industrial demand represents 60 to 70% of total demand, compared to 10 to 15% for gold. This means silver prices depend primarily on industrial economic growth rather than monetary demand, making it a pro-cyclical investment rather than counter-cyclical protection. If you've been following silver speculation for wealth preservation, you've likely experienced multiple 50 to 70% drawdowns that destroyed your purchasing power precisely when you needed protection most. Consider the opportunity cost. If you had purchased gold instead of silver over the past 20 years, you would have achieved similar or better returns with dramatically less volatility and psychological stress. For every silver speculation success story, there are dozens of wealth destruction stories that don't get publicized. The Hunt brothers' 2011 collapse victims and Reddit rally casualties represent the normal outcome of silver speculation, not aberrations. Why is silver speculation particularly dangerous in 2026? Because current market conditions combine maximum speculative appeal with maximum wealth destruction potential. Industrial demand narratives are stronger than ever. Green energy transition, electronic vehicle adoption, 5G infrastructure deployment. These stories attract new waves of speculative capital from investors who believe they're making logical supply-demand investments. Monetary collapse psychology is intensifying due to inflation concerns, currency debasement fears, and geopolitical tensions. This attracts precious metals investors who view silver as affordable gold alternative without understanding the fundamental differences. Market manipulation capabilities have increased through algorithmic trading, ETF structures, and derivatives complexity. Large institutions can engineer boom-bust cycles with greater precision and speed than historically possible. Social media amplification accelerates speculation cycles and attracts inexperienced investors who lack historical perspective on silver's wealth destruction capabilities. Reddit rallies and YouTube promotion create artificial demand that enhances manipulation effectiveness. These conditions create the perfect storm for silver speculation. Maximum narrative appeal meets maximum manipulation capability meets maximum inexperienced speculative capital. The outcome is predictable wealth destruction on a larger scale than previous cycles. If you understand market mechanics, 2026 represents maximum danger for silver speculation rather than maximum opportunity. The forces making silver seem attractive are the same forces that will destroy speculator wealth systematically. Given these realities, here are 3 fundamental principles every precious metals investor must understand. Principle 1. Understand monetary assets versus industrial commodities. Gold and silver are not equivalent precious metals with different prices. They are fundamentally different assets with different functions, risks, and return characteristics. Gold is primarily a monetary asset with minimal industrial uses. Its value derives from wealth preservation, central bank reserves, and monetary insurance functions that become more valuable during financial instability. Silver is primarily an industrial commodity with monetary psychology attached. Its value derives mainly from industrial demand that becomes price-sensitive and substitutable when speculation drives prices higher. If you want precious metals exposure for wealth preservation, understand that gold and silver serve different purposes. Gold provides monetary insurance, silver provides industrial commodity speculation disguised as monetary protection. For wealth preservation purposes, gold's stability and liquidity make it superior to silver's volatility and manipulation susceptibility. This doesn't mean gold is without risk, but the risks are different and more manageable than silver speculation. Principle 2. Recognize speculation versus investment. Silver speculation is not precious metals investing. It's commodity speculation that uses monetary psychology to attract capital from investors who believe they're making conservative precious metals allocations. Speculation involves betting on price movements based on supply-demand narratives, manipulation theories, or crowd psychology. Investment involves purchasing assets that generate cash flows or maintain purchasing power over long time horizons. Silver speculation requires timing entry and exit points correctly to avoid wealth destruction during inevitable boom-bust cycles. Silver investment is impossible because silver doesn't generate cash flows and doesn't maintain purchasing power consistently. If you choose to speculate in silver, understand you're making a trading bet rather than a wealth preservation investment. Size positions accordingly and prepare for 70 to 80% drawdowns that may last for years. Don't confuse silver speculation with gold ownership or other wealth preservation strategies. They serve different purposes and carry different risk profiles that require different position sizing and time horizon considerations. Principle 3. Focus on wealth preservation, not speculation profits. The goal of precious metals ownership should be wealth preservation during monetary instability, not profit generation through commodity speculation. Gold serves this wealth preservation function effectively over long time horizons despite short-term volatility. Silver does not serve this function reliably because industrial demand creates boom-bust cycles that destroy purchasing power when protection is most needed. Wealth preservation requires assets that maintain or increase purchasing power during financial stress. Silver speculation often fails this test precisely when monetary protection is most valuable. If your goal is wealth preservation, focus on assets that have proven protective characteristics over multiple economic cycles. Gold qualifies, silver speculation does not. If your goal is speculation profits, understand you're engaging in sophisticated commodity trading that requires expertise, risk management, and emotional discipline that most individual investors lack. Don't confuse wealth preservation goals with speculation profits. They require different assets, different strategies, and different risk management approaches. The choice facing precious metals investors is clear: understand the difference between monetary assets and industrial commodity speculation, or become another casualty of silver market manipulation. This is not investment advice. This is market structure analysis. The mechanics are documented. The historical precedents are clear. The wealth destruction patterns are consistent. If you've been studying precious metals markets, you know silver speculation destroys more wealth than it creates for individual investors. If you understand market manipulation, you know silver markets are designed to transfer wealth from speculators to institutions. If you've studied monetary history, you know central banks hold gold, not silver, for fundamental reasons that haven't changed despite speculation narratives. Your precious metals strategy must account for these realities, not for marketing narratives that ignore market structure and historical precedent. Silver speculation is not precious metals investing. It's commodity speculation that systematically destroys wealth for individuals who lack institutional resources and expertise. The question is, will you learn from market mechanics and historical evidence, or will you become another statistic in silver's consistent pattern of speculator wealth destruction? This is not a prediction. This is a consequence of market structure that operates with mathematical precision regardless of industrial demand narratives or monetary collapse theories. History teaches us that silver speculation destroys more wealth than it creates. If you understand this lesson, your precious metals allocation becomes obvious.